Welcome, everyone, to this essential deep dive. We are zeroing in on a really important earnings call. It's for a major social media platform, their Q3 2025 results. They just dropped after hours yesterday, October 30th. And look, this was arguably one of the most watched reports this quarter. Why? Well, because the company didn't just, meet expectations. They delivered a significant beat. And they hit that critical profitability milestone, the one they've been talking about since the IPO. The whole story really hangs on them. Successfully monetizing using the scaling AI-driven strategy, making that unique data asset finally pay off.
It absolutely was a must-watch event for the street, especially given the stock's recent performance coming into the call. I mean, yeah, it's been an incredible winter over the last year, up like 63%, but that momentum had stalled a bit. Investors had actually pulled back about, 15.5% in the last month, so there's some clear skepticism building. They needed proof, actual proof that this company could execute on that high-margin growth promise, and, well, they certainly got it. So let's just jump straight into the headline figures, because honestly, they kind of redefined the company's whole trajectory. Okay, SHAP diluted earnings per share came in at 80 cents. That just flew past the consensus, which was around 52 cents. So a massive Israel in 2018. Right away, that signals strong operational efficiency. Revenue also smashed expectations. Came in at $585 million, quite a bit ahead of the consensus, which was sitting around $549 million. That means an exceptional 68% year-over-year growth on top line. But really, for the core investment thesis, the number that truly matters, it's that profitability milestone. Adjusted EBITDA hit $236 million, and that gave them a 40.3% margin.
Now, you, the listener, should definitely remember that 40% margin number. It was the specific long-term goal they set even before going public. They hit it. Yeah. And frankly, earlier than a lot of analysts were projecting.
Right. And the market's initial reaction really seemed to confirm that relief, that enthusiasm. Though, it wasn't exactly a straight lineup, was it? The stock did immediately spike, maybe about 10% after hours, jump from its close around $194.42 up towards $214. But what was really interesting was the volatility that followed. That big spike was pretty quickly met with some heavy selling pressure. It suggests the street is still kind of split on the valuation, maybe. Yeah, it was a bit of a chaotic couple of hours, jumping up, then settling lower. But that initial aggressive pop showed that the fundamental shift, hitting that 40% margin, was a major confidence boost the investor base really needed to see.
Okay, so let's dive a bit deeper into how they actually got to that 40% margin, because this, I think, tells the real story about the power of their financial model. It really seems to be all about operating leverage and keeping costs in check. Looking at the cost side first, gross margin, it expanded by 90 basis points year over year, hitting 91.0%. Now, for anyone maybe less familiar, 90 basis points is just 0.9%, but this is now the fifth quarter in a row they've kept gross margin over 90%.
That shows incredibly efficient service delivery, right?
Yeah.
Pretty much regardless of how much they scale.
Exactly. But the real engine behind that profitability jump, it's that mismatch in growth rates, which is precisely what you want to see in a tech platform that's maturing. Their adjusted operating expenses, the cost to run the business day to day grew only 35% year over year. Think about that for a second. Right. They grew revenue by 68%, but managed to keep their core cost growth to just 35%. That widening gap, that's basically pure profit falling to the bottom line.
That sounds, incredible. But let's make it really concrete for the listener. Management talked about the incremental adjusted EBITDA margin. That's the rate, essentially, at which every new dollar of revenue actually becomes profit. What was that number, and why is it so important?
That figure hit a really remarkable 60%. 60%. This is a number that should absolutely stick with you from this call. It basically means that for every single new dollar of sales they brought in this quarter, 60 cents dropped straight into the profit bucket. Now, in the world of high-growth tech, achieving sustainable incremental margins like 60%, well, it means your business model is fundamentally scaled up. It shows the big infrastructure costs are mostly covered, right? And the new revenue coming in is just incredibly high margin. This is what makes a financial model truly powerful. And beyond just the P&L, the income statement, we have to look at the balance sheet health. Cash generation was excellent. Free cash flow, FCF, hit $183 million. That's a 31% margin just for the quarter. And actually, over the last 12 months, they've generated over $500 million in free cash flow. So this isn't just some accounting trick. It's translating directly into real cash.
Okay, and for growth investors, there's always that worry about dilution, right? The share count creeping up and watering down ownership. What did we see on that front? Was there discipline?
Yeah, we saw a definite improvement there. The fully diluted share count was 206.1 million shares. That actually trended down slightly, both sequentially and year over year. That's very disciplined management. And we also saw improvement in stock-based comp, SBC, that non-cash pay often used by tech firms. SBC fell from 19% of revenue down to 16% of revenue. When you see SBC falling as a percentage of revenue, especially while revenue itself is soaring like this, it sends a really clean signal. It means management is controlling a key source of potential dilution. Very positive for shareholders.
So the cost story is disciplined. Operational leverage is frankly stunning. But obviously the money has to come from somewhere. Let's shift focus now to the revenue engine. What drove that massive 68% overall growth?
Well, the primary engine was, without a doubt, ad revenue. It grew an incredible 74% year over year, hitting $549 million. This really proves that the monetization strategy, which was, let's face it, the core promise of the IPO, is working. And working with amazing efficiency across the board. We also learned that the total active advertiser account base expanded by over 75% year over year. So this wasn't just, the big brand spending a bit more. It was broad-based adoption. Lots of new advertisers coming onto the platform.
And what is it about the ad product itself that's making it so sticky? We hear a lot about AI driving better performance. Were there any specific examples on the call that show they're doing something maybe different?
Yeah, they definitely emphasized ML-driven optimizations, machine learning, specifically focused on lower funnel stuff like getting conversions or app installs. Apparently, these optimizations improve performance for advertisers by over 20%. So the AI isn't just hype, it's making the ads genuinely more effective at driving sales. That keeps the ad budgets flowing, obviously. They also highlighted some unique, high-performing ad formats. They mentioned these conversation summary add-ons. It's where they actually integrate positive comments or discussions from the community directly into the ad unit itself.
Interesting.
Yeah. They specifically called out how a video game publisher, Bethesda, saw 15% higher click-through rates using that format. It kind of shows the unique value proposition of their platform, right?
Yeah.
Leveraging that community input as part of the ad product itself.
Okay, we've talked a lot about domestic success, the ads, but user growth is still critical for a platform like this. How are the actual user numbers looking? And what about that international diversification piece?
Right, so daily active users, the DAUQ metric they use, grew a very solid 19% year over year, reached 116.0 million. And crucially, the international story really seems to be accelerating. International revenue grew 74% year over year. Management credited that to executing their international playbook. Things like machine translation, which they now have in 30 languages, and setting up specific local content frameworks. They called out France, Brazil, and India as key focus countries where this is working well.
Okay, let's touch on the other key strategic angle here, data. That other revenue line, which is mostly data licensing, hit $36 million. Now, that provides some nice diversification, sure, but that line only grew 7% year over year. So if their data, those, quote, authentic conversations are supposedly so strategic for partners like Google and OpenAI, for training LLMs, why is that line item only growing at 7%, especially compared to the ad business growing at 74%? Doesn't that feel like a potential weakness or maybe a bottleneck?
That's a really sharp question. And it's exactly the right skepticism to bring. That 7% growth is definitely slow compared to the ad machine, no question. Management's defense, essentially, was to emphasize the strategic value over the immediate dollar value. They framed it as, highly margin accretive revenue. Revenue that validates the unique quality of the platform's content. Basically, it's like a blue chip endorsement saying their content is critical infrastructure for the whole AI era. So while you probably won't see 70% growth here, the thinking is any growth that keeps expanding overall margins and diversifies the revenue base is still a net positive, even if, it feels a bit like a bottleneck right now compared to ads. And on the product side, they are definitely investing in features to improve user stickiness, retention, and just general usefulness. They talked about Reddit Answers again. That feature uses community insights to make search better. Apparently, it's already handling about 20% of their total search volume.
Wow, 20% already.
Yeah. And now that feature's rolling out to non-English languages too, Spanish, German, Italian, French. The goal there is clearly to capture more global engagement through better search.
Okay, that brings us nicely to the outlook, which seemed pretty robust, continuing that theme of aggressive margin expansion. What exactly did management guide for Q4?
Yeah, Q4 guidance was strong across the board. Revenue expected between $655 and $665 million, and adjusted EBITDA guided to be between $275 and $285 million.
Okay, so if we just break that down quickly, that Q4 guidance implies yet another lift in profitability, right? Forecasting a midpoint margin of around 42%.
Absolutely. And management also noted that average revenue per user, ARPU, grew 41% year over year to hit $5.04. But here's where the story gets really compelling for the bulls. They specifically stressed that $5.04 ARPU remains low on an absolute basis. Now, that's basically management code for saying, hey, we have this massive, relatively undermonetized user base, and there's tremendous headroom to keep growing monetization per user. And following hitting that initial 40% EBITDA target, the CFO explicitly stated the new medium-term North Star margin goal is now 50%. 50%.
Wow.
That is an extremely aggressive commitment. It's based entirely on the assumption that they can keep leveraging that, 60% incremental margin we talked about. They did add a little caution, saying they reserve the right to invest strategically if needed. But the signal to the market is crystal clear. The path to 50% profitability is now the expectation they've set.
All right. And now for maybe our favorite part of the segment, before we wrap things up, we always like to put on our slightly speculative hedge fund pitch hats. And remember the standard disclaimer here. This is absolutely not financial advice. We are simply analyzing the structural implications of this earnings report to generate an outrageous but perhaps plausible trade idea. What have you got for us?
Okay, so given the massive beat, the now proven operating leverage, and this bold new 50% margin North Star, the trade idea feels pretty straightforward. Go long RDDT. And we think the way to play it is using long-dated call options, think, 12-month duration, maybe even longer, targeting the market, eventually pricing in the sustainable achievement of that new 50% adjusted EBITDA margin narrative.
Okay, tell us why you think that aggressive target is actually worth the risk, especially, after the choppy trading we saw immediately after the report.
Well, that volatile after-hours action, even with those huge numbers, suggests to us that the market hasn't fully priced in the sustainability of that 60% incremental margin yet. Or maybe the high-margin, sticky nature of the AI-era data licensing business. Plus, the stock had consolidated pretty heavily recently, right? Down 15.5% in the last month. That potentially provides a cleaner entry point. The trade really hinges entirely on two things. One, Q4 execution, delivering that guided 42% margin, and two, management continuing to show cost discipline while they scale up those high-margin ad products. So essentially, we're betting that the 50% EBITDA margin story becomes the new perceived floor for the stock, driving a significant multiple re-rating over, say, the next 3 to 5 quarters.
Okay, that was the trade pitch. So just to quickly recap the whole call, Q3 was a massive beat on both EPS and revenue. The critical 40% EBITDA margin milestone was hit, and the Q4 guidance was strong, tightly linked to that accelerating AI-driven ad strategy. Now, let's leave you, the listener, with the two big questions we think analysts are going to be really obsessing over in the coming weeks.
Right. First, given the rapid success they just demonstrated and this new 50% margin North Star, what's a realistic timeline for actually achieving that 50% target? Is it 2 years, 3 years? And maybe even more critically, if ARPU, that $5.04, really is still low on an absolute basis, what does the next major platform feature need to be? What's the next big innovation beyond Reddit answers that can unlock that next $5 of ARPU opportunity across their 116 million daily active users? That fundamentally is the growth question that defines the next, say, 5 years for this company.
Absolutely. Something to think about. Thank you for joining us for this deep dive into the Q3 2025 earnings call. We'll catch you next time.